Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for February 28th of 2022. Please see our disclaimer for important information. We can see in our high frequency data this week that we actually do have a new recovery best to report this week, and that's continuing jobless claims of 1.48 million. You can see the pre-pandemic level, it was 1.7 million. So we've made tremendous progress in the labor market. Obviously things are tight, labor is more expensive, that's pretty well understood, but the health overall of labor is actually very, very strong. You can see initial jobless claims as well, down about 6.8% for the week, 11% for the month. Continuing claims there, having hit that new post-recovery best, down about 7 and 11.7% respectively for the week and the month. So staffing index strong as well. As we kind of get into some of the other data, the weekly retail sales is also reasonably strong, as you'll see here in a second. The Omicron wave is largely past us now, and so things are beginning to open up a little bit. There is some trepidation. We've got a chart at the end of the pack that kind of shows a change in consumer behavior in terms of what they're prioritizing, but we'll talk about that in a second. But by and large, all of this data, both on the weekly basis and the monthly basis for hotel occupancy, open table, restaurant industry data, TSA checkpoint data, all really, really strong considering the circumstances. Here is that quick COVID update. We haven't showed you this chart in a while, and I bring it up to kind of point out the fact that the Omicron wave really has rolled over. And you can see both in terms of the spike and the new daily positive cases, rolling over, as well as daily deaths. We know hospitalizations are coming off as well. Reported actually that through the grapevine, I hear that there's only really just a couple of cases in our own local hospital tied to COVID. So that's a significant drop from where we have seen. You can see the magnitude in that shaded blue area underneath that blue line. Now, continuing the theme of this economic power behind things here, when we're talking about Ukraine, we're talking about interest rates, and we're talking about inflation. That seems to be a mix that would not necessarily sit well with the economic backdrop. But as you look here, this is the Kansas City Fed's index of activity, and you can see in the upper left-hand corner the manufacturing index turning back up again here in the first couple of months of 2022. The manufacturing index itself, not just the survey data, but the index of observed data, I should say, is up as well. And I put these other two on the right-hand side to give you a little bit more perspective. So we've got the supplier delivery times moving down, positive in that respect, that things are becoming less clogged in the supply chain. And then also average employee work week. So work week is going up, and some of that has to do with the shortage of labor. So, we still hear businesses talk about the shortage of labor as being an issue. I don't know that that's really going to go away anytime soon. And I do think wages are going to be sticky and will be a consistent contributor to inflation really as we head through the end of this year and into 2023. A little bit more commentary here on the supply chain issue. Now, looking at this chart, you would tend to think that things are beginning to ease up a little bit. We've got rail car loadings of containers and inbound containers from Port of LA and Port of Long Beach here. You can see that this trend line does suggest that, the surge that we've seen from, all of this goods demand over the last year and a half, if you will, is beginning to slow up a little bit. So I think in some respects, as the economy opens up and some of the spending shifts to services versus goods, as well as, and I'm kind of foreshadowing the chart at the end, that consumers right now, because of inflation, are prioritizing their spending dollars a little bit more now on basic necessities and utilities and things like that that have gone up. Gasoline obviously has gone up, and so demand for goods has kind of ebbed a little bit, and what that's done is actually helped to clear up some of these port issues. And I thought I'd show this from Oxford Economics as well, and this is just a probability distribution. On the left-hand side, probability on world growth over the next couple of years, and the light blue represents 2022. And that is skewed a little bit more to the, maybe call it the 3 to 5% overall growth rate range. Whereas if you go to 2023, not too surprisingly, as we kind of get into a more normalized flow and incorporating the expectation that things do slow down a little bit because of inflation, perhaps, that those numbers are skewed a little bit more towards the, we'll call it the 2 to 4 range. So, that is shifting a bit, but again, not terribly surprising. And we hear this in the rhetoric, and now we can certainly see this in the survey data. Again, but it is positive, and that's something to stress here, is that we're not looking for a degradation or retrenching of growth, just slower growth than what we might witness here this year. Now, on the right-hand side, we've got kind of an overlook or look into the next 2 years rather, and you can see that while there are risks that are slightly tied to the downside, that's the largest bar, and the red represents December, and the blue represents the latest survey, which is essentially about a month and a half later, and you can see that not a whole lot of change. I mean, I think there's still some trepidation out there that maybe risks are skewed a little bit to the downside over the next 2 years, but the sentiment hasn't changed appreciably over the last couple of months. We've got a few charts here coming up that were reported in a research piece by FS Investments, who I have a lot of respect for, and is talking about the health of the economy, talking about the health of the consumer, really. Annual debt service costs here in this particular chart have gone down both for corporate America as well as for households. We know that interest rates are moving up, but a lot of companies, for their part, were aggressively taking on debt and refinancing debt when rates were extremely low. So they've locked in low rates. So I'm not going to say that they're perfectly insulated, but they're more insulated than they certainly would have been had we not had that significant rate drop in this pandemic that allowed them to take advantage of it. Now, households, for their part, too, have done a really good job of that, and some of this is related to housing, right? So we know mortgage rates have been low for a while, and the weight of housing within the total consumer's debt basket is obviously pretty high, and so that has something to do with it. But here, really the ability to weather a little bit of a near-term storm related to inflation and what have you. You can see here that both corporations and households are better able to weather that than they certainly were 5 to 7 years ago. Excess personal savings are up. Now, while they have kind of flagged a little bit, and we've noted this previously, so obviously we had transfer payments from the government, and we know that some of this in the upper income cohorts were just simply saved. So there is a lot of dry powder out there. As you can see, $2.5 trillion. Now, it's not necessarily going up, but it does represent a tremendous pool of liquidity and a potential pool of pent-up spending when the environment does improve a little bit. Here's business spending. So we've talked about the intentions on the part of companies to invest in their infrastructure, to expand their operations at a time where growth is viewed as being biased to the upside. Now, we've already seen here this week that some of these surveys are suggesting that risks may be skewed to the downside, but I think it's important to note that the overall outlook is still for positive GDP growth. We saw that in the surveys for not only the current year, but for the next 2 years. While risks are skewed, there's still a feeling that there's going to be positive upside of growth that is it gives them the comfort to spend on technology as well as basically institute capital spending programs elsewhere. Well, it wouldn't be complete if we didn't have an update on crude inventories. You can see in the red as we start the year that inventories are very low, and I could show you 3 or 4 other charts that would corroborate the issue that we're facing right here, and whether it be distillate inventories and stocks, those are extremely low and below 5-year averages. And this is something, unfortunately, that does get tied into the Russian-Ukrainian issue in the sense that we are importing some oil from Russia every day, and that would not be the case had we proceeded with the Keystone pipeline. But be that as it may, it's something that we've got to deal with, and so it is. The real issue on prices in energy right now are tied to the supply issue here. But also tensions, geopolitical tensions, also factor into that as well. And an update here on housing. This is pretty intuitive, but single-family rents are going up in a lot of places. You can see that on the right. Anywhere between 12 to 36%, depending on where you live. Here in our local metro area, Austin Round Rock, up 16%. The November 2021 median rent here is about $1,830. On the left-hand side gives you kind of a composite view from CoreLogic, and this is the rent increases year over year, and you can see that number, for the most part, is around 11-12% overall. And then, obviously tying it back to the right-hand side, you see some of these metro areas are well above that. Now, when we talk about, tying the economy to the markets, and we're kind of getting into some of this a little bit now, but Scotiabank panic euphoria indicator, well into panic now. So obviously we've seen a lot of volatility. Volatility manifests itself in a lot of different ways, and you can see here that that is pretty well tied to panic and euphoria. And right now, panic is a very high point, and then the bull and bear spread is in as much bear territory as we've seen it since 2013. You can see that these numbers are heavily skewed to the kind of the pessimistic end of the scale. You can see here the NASDAQ 100 had a tremendous intraday move, and this is actually on Thursday, and it's as large a move as we've seen since the global financial crisis, which is nothing short of outstanding in terms of its magnitude. As weak as the NASDAQ has been, we saw a tremendous shift of sentiment, intraday, the likes of which we haven't seen, like I said, in quite some time. I thought this was really interesting. Again, from FS Investments, ties Treasury yields moving higher, which is in the black, and that's been extremely well observed and has accelerated lately because of this feeling, this expectation of interest rate increases. In fact, the Fed has done such a reasonably good job after they realized that they had made a terrible mistake and grossly underestimated the longevity of inflation and durability of it. They finally admitted, hey, we are going to be doing something about this, and really foreshadowed the rate tightening cycle that began to move that 2-year Treasury at a pretty rapid clip. And you can see in that orange line there what it's done to the S&P 500 forward PE ratio. And there's some really good research out by FS Investments talking about the impact on multiples. And here you can see that the price to earnings multiple has actually gone down, from a peak in August of 20 of about 23 times, and it's now down about 19 and a half. So, I mean, we've actually seen 3 full multiple levels or multiples be taken out of the market even before the first Fed rate hike. And so, again, against the backdrop of all of this volatility, I think it's important to realize that this foreshadowing and the expectations that are being built into short-term rates are actually doing a lot of the job of the Fed. And I think there's a really decent case to be made that the Fed is not going to have to work as hard because some of this work has already been embedded into market prices, not only in terms of obviously shorter term interest rates, but also in terms of bringing equity market multiples down, because you're essentially increasing, anytime you increase interest rates, that tends to obviously increase the discount rate in which you're applying to earnings. And in this case, with those rates moving up, multiples inherently almost always move down. And more to the subject of the impact of rate increases on earnings multiples. And this is from that same research piece by FS. And what it's doing is analyzing how much of the multiple impact, and this is like the decline in the price to earnings multiple for the S&P 500, has happened before the initial rate hike, which is where we are now, right? So Fed is meeting next month, widely advertised that they're going to be raising rates. And so we're sitting in that area that's represented in that orange block there. And you can see all of these various rate tightening cycles, whether it be 83, 1987, 94, 99, 04, and 2015. Well, right now we have seen 3 multiples be taken out of the S&P 500. We saw that in the last chart. We've basically gone down from like 23 times earnings down to around 19 and a half times earnings, call it. I mean, we've actually almost traversed 4 multiple units here, and that's before the initial rate hike. And we haven't seen that much be taken out of the equity market in any of these prior rate cycles. But what's really interesting, though, with the exception of 1987, which had other issues attendant, that most of these other rate tightening cycles had a net change in price to earnings multiples of about 2 to 3 points, and we're already there right now. That's not to say that that we're not going to see more multiple degradation in the future, because obviously we've got some other things going on right now. We will have quantitative tightening happening too. So the Fed's going to be reducing its balance sheet and having further withdrawal of liquidity. So it's possible that we have more than 3 multiple points be taken out of the market. But I think history would suggest that a lot of this damage in the equity market has been done already. And if that is the case, and multiples aren't going to contract that much further, then really the action in the market is going to depend pretty heavily on earnings over the next couple of years. Well, in talking about earnings, and I think this is also pretty important to mention here, that in certainly more than half of the instances in some of these other rate tightening cycles, that once you get that first rate increase, that by and large earnings can continue to expand for a long time, for literally several years. And so you can see that graphically depicted on the left, and on the right you actually have a table which gives you the aggregate data here. So in these rate tightening cycles, you can see the change in forward 12-month earnings per share increase, with the exception of 1999, which was an odd time because that was a very prolonged, the tech bubble burst, and technology was such a huge percentage part of the S&P 500 at that time. So that's a bit of an outlier not unrelevant, but a bit of an outlier. But you look at these other cases, earnings grew tremendous over a 3-year period. And you can see here that the corresponding S&P 500 return over those three years, 36 months, was actually pretty strong. So, I mean, I think this builds a case perhaps that if we can hold, again, if we go back and say, all right, the earnings multiple of the market has come down perhaps as much as it might, or if it goes down a little bit further, it's not going to go down a whole lot more, right? And if that's the case, and we have continued earnings growth over the next several years, then there is a case to be made for the stock market to continue to go up. Here we have a distribution of price change data depending on the level of volatility. And so volatility is defined by VIX. You can trade it. It's an ETF that you can actually trade, but it's a measure of volatility on the S&P 500 index. And to try to make this as simple to explain as possible, when you have a low VIX, like below 12 in that light shaded blue, then you tend to see the market not necessarily move a lot over the next 30 days. I think that's kind of a low volatility environment. That's the environment that we've had for the better part of the last 2 years after we came out of the economy being closed down for the pandemic. So low volatility, gradual trend in the market, not a lot of price change over a 30-day period, but generally skewed to the positive. Well, if you get more volatility, like say between 12 and 30, then you get a broader range of potential returns over the next 30 days. And then if you get a really strong volatility, which is what we had last week, and that's above 30, that is an upheaval type situation in the market, which is what we had. And I think I show this chart really to emphasize that dark blue. So when you look at the low volatility environment, you get like a general positive trend in earnings. Maybe this is kind of trending more to like 2 to 4% over the next 30 days. But now, if you have really strong volatility, by and large, on average, you get 4 to 6% return. So we've had a really strong upheaval in the market, and what this chart tells you is you tend over a 30-day period to get a stronger price response, a more positive response in the market here over the next month. And here's a chart of growth versus value, bringing you back up to speed. We know that growth has outperformed over the last few years, but it's certainly taken a back seat to value here over the last really 4 or 5 months. And here, the 3-month trailing relative return, so when you see in that orange area, that's periods in which value is outperformed, which it absolutely has over the last 3 months of last year and into this year. And it has outperformed growth to an extent that we haven't seen since 2001. It's been pretty dramatic. So we talk about this shift in emphasis and opportunity in the market to more cyclical companies versus these momentum growth companies, right? A shift from growth to more value. Frankly, that shift is well underway, and we've seen tremendous movements in this relative differential. And so there's still opportunity, considerable opportunity in value, but we can see that we've already made up quite a bit of ground here in this chart. Here's a quick check-in on gold. Obviously, when times get a little challenging and uncertain, oftentimes we do see a shift to gold, a lot less volatile than trading cryptocurrencies. You can see that we had been in kind of a consolidation phase, as defined by the red and the green there. Gold has been kind of, really trending for a better part of about 15 months now. You can kind of see that. We've had a little bit of an uptick in 2021, but really since that up and down that we've seen, It's just been really moving sideways. Now, just having broken out of that consolidation here lately could be, from a technical standpoint, positive in the sense that we might get continued movement to the upside in gold. Here's a couple of commodity updates for you. We've got aluminum moving higher. That's any of you in the construction industry, that's clearly something that you already know. But on the wheat side, we see soft and agricultural commodities continue to move higher as well. And the wheat chart here, again, the data series goes back to 2012. It's about as poignant a chart as you can have in the commodity sphere. And obviously, the Russian invasion of Ukraine is significant because Russia and Ukraine are significant producers of wheat and contribute to the global supply. And so when you look at really spot and near-term forward rates, they're clearly impacted by this conflict. And here's a quick chart, speaking of Russia and Ukraine, of what their non-energy commodity exports are as a percent of global. So when you look at basically Russia and Ukraine together, they account for 25% of the global exports of wheat. And so that's why we've seen that spike in wheat prices lately. Palladium is a critical element that goes into a lot of electronic semiconductor components. Corn, and you look at Ukraine's a much bigger player in corn, but that's 15%. And you go back to palladium, that's obviously not insignificant. None of these are insignificant. Platinum, aluminum, they're all in that basket. And so obviously anything that has a significant concentration of exports tied to either of these countries is going to be up. So just as we saw with wheat, obviously this is having an impact on that aluminum chart that we saw on that last page. Well, and the financial markets are generally don't take too kindly to countries involved in conflict, especially emerging and developing economies. Developed economies are much more insulated. You never see this with the United States, but you are certainly seeing it with Ukraine. The left-hand chart represents the change in the 2-year government bond yield. This is a sovereign yield that at its lowest point was probably about 5 to 6%. Tensions increased, it jumped to about 15% and then eased off a little bit. Now you can see that 2-year government bond yields in a country that's being torn apart around 80%, highly speculative. And then consequently, on the right-hand side, you've got the Russian 5-year spread to treasuries. And so this is basically a spread between the Russian 5-year bond and the U.S. 5-year treasury. And you can see that has been oddly narrow for many, many years, but is now, really blown out to 16 percentage points. And as we get closer to the end here, this is one that I foreshadowed at the beginning of the chart pack. And this is just really a shift. I thought it was really interesting from Trehan Macro. Consumers are planning to spend more on necessities, groceries, utilities, education. This is, from a Nielsen survey over the next 12 months. This is in the wake of maybe some of these consumer jitters, maybe it has something to do with inflation and some of the realized prices that people are actually seeing at the gas pump and the grocery stores, and realizing, hey, somebody's asking me what I'm going to be spending my money on over the next 12 months. It's probably going to be a little less of out-of-home entertainment, dining, eating, travel, especially international travel. You can see all those are distinctly negative. And gym memberships, all of these discretionary items are taking it on the chin right now. And you can actually see this in the market manifest itself in consumer discretionary stocks, by and large, kind of getting hammered a bit right now. But, and you can see consumers emphasizing utilities, education, childcare, and stay-at-home entertainment, those types of things that I think that people are seeing clearly increases in right now. And we'll end on this chart. I don't know that it surprises anybody, but the younger generation is just frankly wired differently. Millennials and certainly the Gen Zers are just wired differently than baby boomers and the kind of the Gen Y crowd. And you can see in the black bars here, the last, and this is a bar chart of the last time you changed jobs ranked by age. And so you can see that, that in the older generations, you tend to stay with your jobs a lot longer, but in the younger generations, that is definitely not the case. We see, very high quit rates out there. I mean, record high quit rates. I mean, as people literally pulling up tent stakes and leaving their jobs and generally not staying that long. You see the 33% of the 18 to 29-year-olds changed jobs within the last year, and another 21% over the last 1 to 2 years. And so, it's just a matter of fact. I think we're going to have to just acquiesce to the fact that the younger generations are just going to be changing jobs much more often and thereby increasing the mobility of labor. Well, that's all that we've got this week. Hope you've enjoyed the chart pack and alert you to also the interim intro week, I guess I'll call it, chart pack that we did specifically related to Russia and Ukraine and the volatility impact that it had on our markets last week. There's a lot of good slides that help to drive historical perspective, that help to hopefully give some people some longer term comfort that despite the volatility that we saw last week, both positive and negative, that over longer periods of time you tend to see much better performance in the investment market. So hope you have a wonderful week, and we'll talk to you again soon. Take care. Bye.